Boxer has reported an 11.8% decline in full-year headline earnings per share. That's because of an increase in the number of the grocery retailer's shares due to its initial public offering. While no dividend has been declared for the year, the firm says it remains focused on long-term growth and aims to pay out 40% of HEPS from the 2026 financial year. Meanwhile, the company opened 48 new stores during the period and says it plans to open another 60 stores in the year ahead. Redefine has delivered a 3.6% rise in distributable income during the firm's half year. The real estate investment trust has declared a dividend of just over 20 cents, which is in line with the previous period's payout. Despite the uncertain operating environment, Redefine says it expects full-year distributable income per share of between 50 and 53 cents and a dividend payout ratio of around 80%. Balwin's 2025 financial year shows a tale of two halves. The residential estate developer faced a difficult first 6 months, but managed to recover somewhat in the second half, and so has presented a mixed set of annual results. Revenue during the period fell 6%, while profit rose 8%. Balwin says the numbers reflect the sustained economic pressure on consumers due to a prolonged high interest rate environment and growing local and international political uncertainty. As a result of this, Balwin says it will err on the side of caution and not declare a dividend. Instead, it will focus on reducing debt. Calgro M3 has posted a 9.3% slump in full-year headline earnings per share. That's as revenue declined by close to 33%. The property company says this is as a result of the group's strategic decision to slow production in the first half of the year. That's as it countered political uncertainty and lackluster consumer demand. A final dividend of 8.6 cents has been declared. That's 8.5% lower than the previous period's payout. MTN has reported a robust first quarter. During the period, earnings before interest, tax, depreciation and amortization rose 33% in constant currency terms. The mobile operator says this reflects strong service revenue growth, improved stability in the macroeconomic environment, and lower device cost of sales in MTN SA. Looking ahead, MTN has stated that it's on track to meet its 3-year target of at least 7 billion rand in expense efficiencies by 2026, and its overall medium-term guidance framework remains unchanged. Tiger Brands has made formal settlement offers to victims of the 2017-2018 listeriosis outbreak. The food producer says the offers included an undertaking to pay proven or agreed compensatory damages in line with Section 61 of the Consumer Protection Act, and this is being done without admission of liability. The company believes the move is a significant step towards resolving the litigation. In a subsequent statement, the firm representing the class action, Richard Spoor Incorporated, welcomed the settlement offer, calling it a positive move towards corporate accountability, responsible citizenship and justice for victims. The update on the case comes alongside a trading update from Tiger Brands. The firm expects interim headline earnings per share from continuing operations to be between 30 and 40% higher. The company will open its books on the 28th of May. Lewis is expecting a profit bump. The furniture retailer has forecast a rise in full-year headline earnings per share of as much as 65%. That's as it benefited from a strong trading and operational performance that was driven by continued strong growth in credit sales, expanding margins and robust growth in the debtors book. The company will release results on the 29th of May. South32 has alerted the market to its succession plan. The diversified miner has appointed Matthew Daly as Deputy CEO. He will join the company in February 2026 and then take on the role of CEO when Graham Kerr steps down later in the year. Daly joins South32 from Anglo American, where he is the Technical and Operations Director and a member of the executive leadership team. To fill that gap at Anglo American, the miner has appointed Tom McCulley as technical director with immediate effect. He will work with Dali over the coming months to ensure a smooth transition. In international news, OpenAI and Microsoft are rewriting terms of their multi-billion-dollar partnership in a negotiation designed to allow the ChatGPT maker to launch a future IPO while protecting the software giant's access to cutting-edge AI models. Let's take a look for more detail.
OpenAI is talking to Microsoft about rewriting the terms of their multi-billion-dollar partnership. That's according to a report by the Financial Times. It says the plan is to allow the ChatGPT maker to launch an IPO in the future while protecting Microsoft's access to cutting-edge AI models. One critical issue is how much equity the software giant will get in exchange for the more than $13 billion it has already ploughed into OpenAI. The report says Microsoft could give up some equity in return for access to new technology developed beyond a current 2030 cutoff. The pair are also said to be revising a wider contract first agreed when the Windows maker invested an initial $1 billion in OpenAI in 2019. There was no immediate comment on the report from either party. Tech publication The Information said last week that OpenAI has told investors it will share less revenue with its top backer as it moves ahead with restructuring. The firm has recently dialed back plans to become a for-profit company, instead leaving its non-profit parent organization in charge. In January, Microsoft changed some terms of a deal with OpenAI after it entered into a joint venture with Oracle and Japan's SoftBank to spend up to $500 billion developing new AI data centers in the US.